G'day everyone, welcome back to Pete's Investing and Trading channel. Today we are trading the CCI 14 strategy with average down. We compare against the CCI 100 period with a moving average. This is a little bit more complicated of a strategy, but we will see the outcome and profitability of this. In this video we'll cover the entry, exit, average down rules for each strategy, review charts for each company and table the results for each strategy. And stay tuned until the end of the video to review the trading guidelines and trading rules. Don't forget to review our playlist, which covers trading strategies, share price and indices reviews, and this video will be covered in the strategies playlist. We're not offering financial advice, but rather this is an educational series to help you make better trading decisions. And let's get started. I'm about to demonstrate the entry and exit strategies with two scenarios. The first scenario is where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit the trade when the closing price gains at least 5%. Take your profits and wait for another trade using the entry rule. We average down when the close of the day declines by at least 5% and the CCI 14 breaks above the zero line. We then buy double the quantity of shares from the previous trade we made. Note, we don't use stop losses. Again, watch until the end of the video to review the trading rules and guidelines. The second strategy we test demonstrates the commodity channel index strategy with a moving average 30 period of this indicator. We enter the trade when this combined indicator breaks above the zero line and the moving average 25 of the share price diverges from the moving average 30 of the share price. That is, the two moving averages of the share price move away from each other. This indicates the share price is rising. We exit the trade when this combined moving average 30 of the CCI 100 indicator breaks below zero, or the share price moving averages start to converge. That is, the moving averages start getting closer to each other. This indicator of the moving averages of the share price is getting lower. Lastly, we average down when the current close is less than the average price and the entry parameters of the above are met again. We enter the double number of shares, and I'll demonstrate this in a bit more in the chart. Let's get stuck into the charts and I'll demonstrate. First off, we'll be showing you the chart for the CCI 14 period moving average, and this is the logic we've been using for the last few videos. And we're going to compare against the other strategy in a minute. So first of all, this is the chart for the first one. So again, our rules are for the entry, when the CCI 14 breaks above the zero, which it has here, this is the CCI commodity channel index 14 period, breaks above the zero, we enter the trade. That's where it's entered the trade there. And we're looking for a 5% minimum gain. As you can see here, the price went slightly down, then up and recovered, and it broke here. On that bar there, it broke above 7%, which is above our 5% minimum gain. So we exit the trade. So we take our profits and get out of the trade. This up here indicates the trade entry and exit, and up here is the profitability of that trade. So you can see here the profitability, baseline's 100,000, so profitability finished there at 20,041, and it started off at 19,916. So it made a nice little gain in a few days there. The average down using the CCI 14 happens here in this example. As you can see here, enter the first lot of shares there and a second lot of shares there. I'll explain how that works. We enter our first lot of shares there when the CCI 14 breaks above zero, which we did. Now the price goes against us and the price falls below 5%. I've drawn a little ruler here of the 5% drop. So it's gone below the 5% drop as one of our entry parameters for the average down. As you can see here, the CCI 14 breaks below zero, but then it finally breaks above zero there. That's where it did there. So it's now above zero, but we're still below our 5% drop. And that's where we enter our second lot of shares there. Finally, we close out the trade when that 5% gain, assuming the average is around there somewhere, the 5% gain is made. So we get out of the trade there. Hence the trade is closed there. Again, our profitability is 19,743 in this case. Opened up at 19,419. So made a few $100 in those few days. Next, we look at the logic for the moving average 30 of the CCI 100 and the moving average 25 and 30 of the share price divergence and convergence. First, I want to explain the CCI 100 with the moving average 30 applied to it. So this is the final result we got. You can see this is a CCI 100 with a moving average 30 applied. This is the raw commodity channel index 100. As you can see here, there's a lot more sort of jagged edges. So what I've tried to do is apply a moving average to that, just to smooth it out more, so we don't get any sort of spikes like this and that, jumping up and down. So when I put a moving average to it, to give it a bit more clarity. This will demonstrate the single entry for a commodity channel index 100 with a moving average 30, and that's the commodity channel index there. Remember I showed you earlier, we just smoothed that CCI 100 out. So I'll just zoom into this little example. So this is the first parameter is the CCI 100 must be above the zero line. That's the zero line there. So that's the first parameter. The second parameter is we enter the trade when the moving average 25, which is that red line, moves away from the moving average 30. As you can see here, it's moving away, which means the price is accelerating. So that's our first parameter to enter the trade. So we do so at that point there. Now you'll notice here, our exit strategy is if the moving average, the CCI 100 moving average 30 breaks below zero, which it hasn't done, but it finally breaks and closes the trade on that point there. And the second parameter is if it must be CCI 100 breaking below zero, which it hasn't. So that's or the moving average 25 starts moving towards the moving average 30. Now it does so here, but it doesn't close out because our second parameter means that the price must go above 10 points or $10 in this case. So I've drawn a little ruler here. This is a $10 marker. You can see there it just missed out on breaking above there. But you'll notice here the moving average 25 is breaking and moving away from the moving average 30, so it hasn't closed out. So it didn't close out here because it's not within our $10 range. So it didn't close out. It starts moving up. The moving average 25, the red line, starts moving away from the blue line, the moving average 30. So we keep our trade open until it finally closes out at that point there. You can see there, if you look at that, it's above our $10 limit. And it's hard to notice, but our moving average 25 starts moving towards our moving average 30, so it closes out. That's our single trade. So it opens up there, stays within the trade there, keeps going, and it closes out at that point there because it's gone beyond our $10 gain from our entry point. This demonstrates the averaging down of the CCI 100 moving average 30. So we enter our first lot of shares at that point there because the CCI 100 moving average 30 is above our zero line, and the moving average 25 of the share price is moving away from the moving average 30 of the share price at that point there. So we enter our first lot of shares there. The price goes sideways for a while. There's a bit of a divergence from the moving average 25-30, but we ignore that. It hasn't gone above our $10 limit. Remember, our $10 limit needs to be greater than that point there. Now we enter our second lot of shares there because it meets two criteria. The first criteria is it breaks above moving average 130, moves above the zero, which it has there. Also, the moving average of the share price, 25 versus 30, is starting to move away from each other, which it does there. So we enter our second lot of shares there. And finally, we close it out. The average price now is somewhere in that range there. At that point there, the moving average 25 of the share price starts moving towards the moving average 30 of the share price. So we close out our second lot of shares there. You can see here the profitability for that point is 18,666. We started off with 18,299. So again, a nice little gain there. These are the results of our CCI 14 breakout strategy. Now we are trading $2,000 per trade. We're beginning back testing in January 2007, which covers the GFC, COVID and the Ukraine downturns. We show total revenue per stock, the number of times we had to average down, and the total drawdown effect. Then a monthly average revenue based on the number of months from 2007 until today. And these are results of the backtesting the CCI 100 with a moving average 30 applied to the indicator. Note we only traded $1,000 per trade versus the $2,000 in the other strategy. This table summarises the two backtested results. Note the revenue generated by each, but especially the drawdown required. The profit over drawdown percentage is our key indicator for efficiency. The CCI 100 with a moving average 30 strategy had a better result overall for the 7 stocks. It showed better profits, albeit a higher drawdown, even though we traded with less funds per trade. So today we covered a couple of simple trading strategies with a better profit probability of the price increasing from our entry point. There are many videos which show you how to enter a trade, but most of them don't clearly explain how to exit the trade profitably. In this video we showed you an effective way of exiting the trade profitably. Note also we don't use stop losses. That's a sure way of minimising returns and more often than not losing money from your trading account. Instead of stop losses, we use the average down strategy with some disciplined money management. We show you how to effectively average down and ultimately close out the trade profitably. This approach has been backtested on stocks, CFD indices, commodities and Forex currencies. Again, the key here is a good money management approach, especially in trading leveraged instruments such as CFDs, ETFs. Today we backtested and traded that is buying stocks outright with our own funds, not leveraging off borrowed money. We show the calculated funds required when following the drawdown approach. We go and backtest to the start of 2007. And that shows the effects of the GFC, COVID and the Ukraine downturns. On average, we show the returns that would have been generated had you traded $2,000, and more recently in our new strategy, we traded $1,000 trades. These returns do not show the returns of dividends, so any dividend payouts would have been added as extra bonus on top of the revenue generated. Some of my investing rules: buy proven blue chip stocks only, avoid speculative stocks. This ensures probability of the shares of the company you're buying has had a good track record and more likely potential of future growth. Buy stocks which pay dividends. That just allows you to get some revenue if your stocks happen to be held for an extended period of time. Don't short positions, go long only. If you short an instrument which pays a dividend, you'll end up paying that dividend to someone else who went long in the same instrument. Do not trade on news. Price has already been factored in the share price. If you read an article in the finance pages which talks about an event of the stock you're considering, the chances are it has already been factored in the share price, so you've missed that boat. I did a video in September 2021 titled Uranium Stocks Too Late to Trade, which demonstrates the effect of that news, and it probably must have already happened in the share price. I suggest you watch that video. Thanks for watching. Don't forget to click the subscribe button, the notification bell. Happy investing and see you in the next video.